half is as weak as the first, they might not achieve their coveted 5% growth target this year.
And of course, we'll learn more tonight with that additional data that will come through. But you mentioned the property market. Let's talk a little bit about Country Garden. What exactly is happening there?
So we have seen so many property developers in China default. And we had seen these expectations that policymakers would do more. Yes, we have gotten some indications that they will ease those property restrictions, but that doesn't seem to be necessarily helping companies like Country Garden. This was one of the biggest, strongest players out there. Now it's fallen to 6th place in terms of sales volumes, and we're hearing from bondholders that they haven't received coupon payments effectively due Monday. So their stocks and their bonds, as you can see there, falling down to the lowest level since November. We're talking about the fact that despite the missed coupon payments, we do have a 30-day grace period, but investors thinking, what happens next? Can they be one of those rare property developers that actually avoid a default? That's the key question. They've already said that for the first half of 2023, they're going to swing to a net loss. And the indications of how they're dealing with the government may not be that great. So we have a new governor, Pan Gongxie, from the People's Bank of China, right? And he was meeting all of these business people. There was a list. Country Garden wasn't one of those people that they were meeting. So when they do actually implement all of these policies to support these companies, will they benefit is a question.
Before we let you go, Sherry, I do want to go through some of the other numbers that we got, including on foreign direct investment. We're looking at what? It was over 101 billion a year ago in the first quarter of 2022. That dropped down into the 20s. It was 5 billion, am I reading that correctly, in the most recent quarter?
Slumping to just 4.9 billion in the April to June period, which would make it a slump of 87%.
Are they just not taking money anymore? What's happening?
So right now it seems that, according to analysts, perhaps the supply chain diversification is working against China. Last night, I had an emerging markets analyst from Deltec saying, you know what, Mexico is a more interesting story because the realignment of supply chains is already happening that way, especially with those trade tensions, geopolitics being an issue, and the economic recovery slumping.
Well, you saw the story, too, about Mexico and some of these other countries now doing more trade with the U.S. than the U.S. is doing with China. That's a record low. That's a pretty alarming number, and it really illustrates, I think, some of the stress that's out there right now.
And last night I was asking, what will happen to the super peso? Remember the super peso has been so strong? And the analyst from Delta, Greg Lesko, telling me that will continue because there's really no reason for it to fall, especially with the Fitch downgrade of the U.S. credit rating. U.S. dollar investors have gotten this wake-up call there going to the Mexican peso.
Yeah, we got to have you back on to talk about the foreign direct investment. How do I reach you?
Call, text, Instagram, guys, Twitter as well.
Or just shout loudly in the newsroom, and we'll figure it out. But for now, our thanks to Bloomberg EM correspondent Sherry On. Now, still ahead on the close, UPS cutting its full-year profit forecast as it grapples with cost-cutting measures in the wake of a tentative labor deal with its drivers. We'll take a deeper look at those results next. This is Bloomberg.
Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges
elections next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
Let's get right to our top calls, the big movers on the back of analyst recommendations. And we start off with Home Depot and what Telsey Advisory Group sees as a soft housing market. Telsey cutting Home Depot to market perform as consumers are showing more caution in how much they spend on home improvements. The analyst over there, Joe Feldman, citing U.S. housing price growth slipping into negative territory on a year-over-year basis, a trend that he says is likely to continue into next year. Home Depot shares only down fractionally on the day. But let's stick with housing and take a look at mortgage underwriter UWM Holdings. Cut to market perform over at JMP. This is ahead of tomorrow's earnings report out of the company. The analyst's main concern here being the impact on mortgage demand given higher interest rates that he expects to remain elevated through 2024. Those shares down 7% on the day. And finally, let's end on an up note. DraftKings lifted to buy from hold over a choice, with the firm calling the sports betting company the best top-line story in gaming today. The analyst says the path to profitability has become clearer this quarter, and he credits management's ability to navigate around some of the risks out there. DraftKings up about 0.6% on the day, and those are some of our top calls. We want to stay in the sell-side space and take a look at UPS. They came out with earnings, and they did miss on revenue in that report. The company now says it's going to resort to cost-cutting as it finalizes labor disputes with its workers. Let's get a broader view here as to what others expect for this company and, more importantly, for the stock. Jonathan Chappell joining us right now. He's Senior Managing Director for Transportation Equities at Evercore ISI. He's got an inline rating on the shares. And let's start off with that earnings report here. Clearly, there was some impact, John, from the Teamsters strike, or I guess the strike averted, we should say, but the costs associated with averting that strike.
Yeah, absolutely. In the second quarter, which is backward looking, it was more of a top-line impact from the uncertainty surrounding the Teamsters negotiations. So management estimates they lost about 1 million packages per day as some of their shippers had to, take other outcomes to go to some of their competitors, about a third to FedEx, a third to the Postal Service, and about a third to regional carriers. The cost impact is going to be more forward-looking. As this new Teamsters contract is finalized, the vote is going on now with the rank and file through August 22nd. So the margin guidance lower from the management of over 100 basis points for fiscal year 23 will incorporate a lot of the costs associated now with this new deal.
And we shouldn't just let them off just solely on the labor costs. There were some other issues challenging this company prior to the labor dispute, just with regards to consumer spending trends and, quite frankly, even some of the aggressiveness that UPS had in raising prices.
Well, I mean, I think the macro point, your former point, is the most relevant here. And clearly, there was a big shift to goods spending coming out of the initial lockdown. Then the pendulum has shifted very aggressively back to services. So all the transport companies I cover, from FedEx and UPS to railroads to trucking, have been hit by the shift away from goods and the destocking of both retailer and industrial inventories. You were speaking about China on the segment before this. The international market from UPS was very weak as well. Revenue down 13%, volumes down 6.5%, pricing down 5.7%. A lot of that is China exports. A lot of that is Europe weakness as well. So there's a big global, macro headwind that's still, involved here in the entire transportation space. It's just that the Teamsters agreement kind of exacerbated some of those problems for UPS and 2Q, and will continue to do so in the back half of this year.
And so focusing on the fact that you do have this shift in consumer, a shift to services rather than that big ramp up into goods that we saw during the pandemic, how does UPS compare to its peers? If this is an industry-wide issue, who is particularly well positioned to handle that?
Well, I'm not sure anyone's particularly well positioned to handle the shrinking pie, so to speak. I mean, UPS and FedEx have had the same type of volume headwinds. The difference is that UPS has been negotiating this contract, which has been a big overhang. The cost inflation from the contract in year one is quite high. We're estimating mid-high single digits, whereas FedEx is now transitioning to more of a restructuring of their ground and express businesses, and their costs are moving the other way around. But whether it's trucking companies who've cut guidance by 50% year to date, intermodal volumes have been down kind of in the mid-teens all year long. Rail volumes have been disappointing. What we really need is for this destocking process to end, for the consumer to become a bit more aggressive on the good side, and restocking to begin again from the retailers. And I think we'll get a good sense of that when the Walmarts and the Targets and Home Depots of the world report in the next 2 weeks.
Yeah, so maybe some visibility there. So interesting to hear all your comments and weigh that against the fact that you are in line on this stock. Now that we have some more visibility over the impact of the labor deal, in addition to maybe some color that we'll hear from Walmart and Target, what else would you need to see to bump that up to a buy, for example?
Well, let me address the first part first, which is we don't have full visibility yet. With the rank and file still voting through August 22nd, UPS management didn't reveal the entire terms of the deal. So the estimate reductions that we made today incorporated the guidance cut for fiscal 23 and our expectation for a lower base for 24. So, for example, we cut our 23 EPS estimate to $9.65 from $10.70. It's pretty meaningful. And for next year, from $11 to $10.25. But when the contract is all signed, sealed, and delivered on the week of August 21st, they will come out with another call detailing line by line the exact cost impact and timing and how they plan to offset some of that cost inflation through productivity and as well as through pricing. So we'll see exactly what the next 12 months holds, I think, in the next couple of weeks.
John, great to catch up with you. Jonathan Chappelle there over at Evercore ISI, a deeper dive into UPS. Coming up here on the big program, a deeper dive into what you wear in the boardroom, Katie. I don't know what you wear, but the cast of Succession, they wore Norwegian wool. And, well, that product placement has vaulted this company into, I guess, the stratosphere, if you will, of name recognition. A sit down coming up after the break, Katie, with the CEO of Norwegian wool.
Looking forward to that.
This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to Bloomberg Markets to Close. It's time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Weston, who joins us every day around this time. And David, there's this thing out there called quiet luxury. Where,
I know.
Yeah, where people are wearing these really nice clothes, but they don't have the big flashy logos and other things that maybe detracts.
See, you are so far ahead of that fashion. I had to learn about this, actually. I didn't know exactly what it was, but you're right. It's all the rage right now. And we actually have one of the pioneers of it. He's Michael Berkowitz. He's the founder and CEO of Norwegian Wool. So welcome, Michael. It's good to have you. We like to talk to CEOs who are really running real companies. What's going on? Explain to us where this came from. I mean, you started out as a commodities trader, not as a fashion guy.
That's right. Well, thank you. It's great to be here. So when you talk about quiet luxury, you know, I don't think that's anything all that new. I think most of us and most people in the audience who really have their own story to tell, they want their brand to be the one that's being worn, not another company's brand. And so when it came to the world of outerwear, when I was a commodities trader, the line I like to say was every year winter would come around and my nice coats weren't warm and my warm coats weren't nice. Just a very simple problem. And I didn't want to wear something that was big and puffy with branding that you could see from the moon and I looked like this Michelin man. And I didn't want to wear my Italian beautiful cashmere coat that looked great, but if it dropped below 45, you were freezing. The pockets were like these awkward pockets that, you know, you can never really put your hands in. So it's just like merging two worlds together of comfort and luxury, and started as a hobby and then saw that other people wanted the same thing and then quit my job and here I am now.
So you're designing and producing clothes for people like you or people like you used to work with, as well as the people on Succession that we've been looking at here. How do you go about deciding what they need and what they want? It's a bit different today than it was, for example, when I was just coming into professional, where we sort of went to Brooks Brothers, forgive me.
Connection lost. Well, the first thing is we actually try to listen to what the customer wants. So I like to tell my own team, we're not in some fancy office away from the people. We want an office with windows. We want to see what people are doing. We take customer feedback very, very seriously. So even before we launched our first line, we actually did market research, asked people what was missing in their nice coats, everything from a better neck closure, better hand pockets, inner pockets, all those types of things, and then we just took that research, put it into a coat. Some of it was easy. Some of it was just like the designers out there just weren't thinking along those ways, and then certain things were actually harder. We actually had to figure out how to do that without making it bulky or heavy, and then we adapt. You know, now everyone is a little bit more casual. You and I were just talking about people want more comfort and more stretch. It's the same concept that we started with 9 years ago, but adapting a little bit to this post-COVID, a little bit more hybrid, a little bit more comfort.
How did you manage to create awareness? Obviously, I mean, we've been showing on repeat here Succession, and I know that brought a lot of attention to it, but there had to be something more to it than that.
So, do you ever watch the movie Moneyball?
Yes, sure. Of course.
So that was a big inspiration for me. There's a great scene where Brad Pitt is telling everyone else who doesn't like what he's doing that if you're going to just play like the Yankees, you're going to lose like the Yankees. If you're going to try to get players the same way they do when their budget is 30 times bigger, you're going to lose to them out there on the field. So we had to think creatively as a startup company who's competing against all these luxury legacy brands, how to get awareness. So the first strategy is not to go the classic classic influencer route and pay people to wear it. We're like, there are a lot of people out there, if they know what we're doing, they want to pay us to have it and then just run with it. So when, instead of getting coats onto the red carpet, which we have, and things like that, but that's all organic, we have been able to get coats out to Davos. And then lots of people wearing Davos, and all these CEOs and C-level people were wearing it to Davos. That got its own story, and a lot of people were more interested in what's being worn to Davos than the saturated area on the red carpet.
I know there was a whole story written about it, and David, I think you were at Davos, weren't you? Once?
I was at Davos.
I didn't see you with the coat, but we saw a lot of our competitors wearing those coats as well. But it gets to this idea too of brand identity too. I mean, he mentioned Brooks Brothers. I mean, for that matter, the first suit I ever bought with my own money was actually from Brooks Brothers. But I'm sure you know that fashion trends come and go, and what people want, or at least what people gravitate to, can kind of change with the time. So how do you make sure that what you've built over 9 years, that we're still going to be talking about 20 years from now?
So if I look at some of the other brand greats that I really look up to, I think they have stayed true to their mission. They have stayed true to what they do, but they adapt. The ones that do complete 180s from when they started very often don't. So in our case, we're staying true to our mission, which is luxury fabrics, mostly wools and cashmeres, infused with all different types of performance. What that means is if people are going a little bit more casual, a little bit lighter weight, you know, if we get into new markets, we're now selling into a lot of more mid-climate markets that don't have a full winter. That is how we'll adapt and expand, but it's staying true to what we do. So we know what we know, and we stay in our lane, and I think that has a lot of bandwidth there. I think that could go for many, many years, you know, with a few twists and turns, but again, in that same lane.
So, Michael, you have clearly a solid start in the business.
A lot of bandwidth there. I think that could go for many, many years, you know, with a few twists and turns, but again, in that same lane.
So, Michael, you have clearly a solid start in the business. How do you grow the business from here? Is it taking market share from others? Is it new geographic territories like China? How are you going to grow it?
So the first big area of growth was actually the women's market. I didn't think I was going to do a women's line. I felt like not coming from a fashion background, the first thing I would do with every new sample is put it on myself. And I knew I couldn't do that for women's wear, so I was a little bit scared to do it. But we were getting so many inquiries from wives, girlfriends, daughters, mothers, everyone who had been buying and saying, when do you have a women's line? So it took us a few years because we felt that that was a harder thing to get a nice silhouette with all that warmth. So that's the first area. Right now, you're going to see a lot more stores carrying our women's. You're going to see a little bit more brand extensions, like into accessories, like waterproof cashmere beanies, which has done really well for us. We tested that out. You're going to see more of those. These types of sport jackets, that was an extension. But again, all of that growth, new markets, the women's wear, new accessories, but still within our expertise.
It's fascinating. Do you have a lot of problems with supply? Because you actually make these things in Tuscany, as I understand it.
Supply, no. It was hard to first get in. A lot of these fabric mills are not interested in working with a new American company. You know, you have to prove to them that you're there for real, that you're going to be there year after year. You're not going to move this stuff to Asia. Right. But once you get in, then suddenly get all these other introductions, and supply has been okay.
Michael, great to have you here. Thank you so much for joining us. My pleasure. That's Michael Berkowitz. He's founder and CEO of Norwegian Wool. Tomorrow, we're going to hear from the former World Bank president. You know him, David Malpass. Yeah. We're going to talk about South Africa, because you know they're having the BRICS meeting down there later on this month. And then on Friday, we're actually going to hear from Rick Reeder of BlackRock about what's going on in the bond market, as well as talk with a real sports expert about what's going on with the Pac-12. I don't know if you noticed it, but there is no more Pac-12.
Yeah,
that's all Friday at 6 p.m. Eastern time.
It's like the Pac-6 right now, David. Thank you. Let's toss it back over to Katie, who has some breaking news. Katie.
We do have some breaking news. Bloomberg News reporting that FTX executive Ryan Salem is talking to prosecutors about a potential plea deal. Of course, we remember Ryan Salem. He was the former co-chief executive of FTX Digital Markets. The specifics, that, according to people familiar with the matter, is that the Republican mega donor, he may enter a plea deal as soon as next month that would be related to offenses including campaign finance law violations. Of course, it's unclear whether he would enter into a cooperation agreement with those prosecutors and eventually testify against FTX FTX co-founder Sam Bankman-Fried. But if this goes forward, Salem would be the 4th former FTF executive to plead guilty. So we'll continue to keep an eye on that, as we do continue to keep an eye on the markets, currently off by about 0.6% remaining.
Yeah, absolutely. Here, we should point out, though, we're actually near the highs of the day, although it is still red across the screen here, so certainly not quite as bad at what it was to start the day. Keep an eye on the yield space now at 30-year, right around 4.2, and the elevation on the VIX, which
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Broker Studio, streaming on YouTube and Bloomberg Originals. It is...
Who is that voice that I hear?
Help me. What day is it?
It's Tuesday. It's August 8th. And that means Carol Masser's back.
Is it August 8th? Oh, I think I have August 7th. How did I do that? I wrote it wrong in the...
Did you write that? Maybe I wrote that on Friday.
All right,
I don't know.
This is why we're a good team. All right, it is Tuesday, August 8th, everybody. Carol Massar along with Tim Stanovic. Good to be back, feeling refreshed, but I feel like the market's bit of churn here in August.
Yeah, 5 of the last 6 days lower on the S&P 500 as of now, Carol. So you missed, it had been a while since we'd seen declines, and like a series of declines. Last week was the worst week for the S&P 500 since March.
It always happens in August. It always happens when I start
the
to go
master
away.
sell-off is what we call it.
Check it out on the Bloomberg. It's a function. No, it's not really. But anyway, we're going to talk about that. We're going to talk about some of the worries that are out there. We're going to talk about banks tanking as Moody's cuts ratings. I feel like the big takeaway is everybody's like, Moody's, where were you in March?
Hindsight is 20/20, as they say, right?
Yeah, thanks for keeping up. We're also going to talk about Tesla's ever-evolving C-suite. Some great reporting by Dana Hull, who follows this company so closely.
And Zach Kirkhorn, who was the CFO there for years, he's been at Tesla for 13 years. He's stepping away with a nice pay package. A new article in the from our Bloomberg Wealth team. A few $100 million. Not even 40 years old.
What do they say? As you're going in, you got to negotiate your out package.
Well, he's set for life.
Note to self, note to self. Plus another day when we are talking, unfortunately, about the weather, no longer a pleasantry or conversation filler. I do feel like the weather patterns, erratic. It's shaping how I do things. I don't know about you, but this has been quite the summer, quite the July. We're going to get into all of this.
Well, speaking of the worry list, the healthcare staffing crisis, that's bad. And guess what? It's getting worse.
We, thanks to our producer, Paul Brennan, and we've talked with Aman Abuzaid, who has been telling us for years about the nursing shortages that are out there before COVID, through COVID. So I feel like this is just layering that story on top of it. We're also going to get into a bunch of earnings after the close, Rivian, Lyft, so many more. And we've got the company that was once at the center of the AI hype cycle and doesn't seem to be that way anymore, Tim.
A company out of London, so we're going to dive into that.
Yeah, exactly. And then how to stop being trapped in the cult of never having enough. Folks, step away, FOMO of things.
It's enough.
It's enough. We've got the author of Money Zen stopping by. All right, right now, though, we've got to focus on the markets. We're going to head over to our TV colleagues. That's because Countdown to the Close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues Tim Stanovic and, wow, to my eyes this evening, Carol Massar.
Who are you?
Finally back here for her 3-day work week. Welcome to our audiences across all of our Bloomberg platforms.
4-day, who's counting?
And welcome back to Carol Massar. You picked a great day to come back here, Carol.
What's going on in the markets? What did you guys do while I was gone? I mean, what a wacky
We
day.
had fun.
I know.
People sold stocks while you were gone.
A little bit of a downgrade. Like, it's just crazy. I mean, look at the banking sector. I mean, is this March all over again? You do have the banking sector definitely tanking, definitely off their lows. But the news, first of all, we came into it with some concerns about Italian banks. That was kind of our setup. And then you had Moody's coming out and lowering its ratings for 10 small and mid-sized lenders, saying it may downgrade some major firms, names that you definitely know. So a lot going on. Take a look at the KBW Bank Index. 24 names were down, and I think they still are down today. And you've got also the Regional Bank Index down about 1.5%, both of them down in today's trade.
I think a big question that a lot of investors had, a lot of observers had, after the crisis we saw in March, Romaine, after the banks failed in California, here in New York, was what's the next shoe that will drop? What will continue to be the effects of the Fed raising interest rates on the financial system? And, I think we got a little bit of an answer in March, and we're getting more of an answer now.
Yeah, right. I mean, it's basically the pullback in business, the pullback in lending, and kind of a shrinking of that whole sector. And we spoke with Dick Beauvais over at Odeon Capital a little bit earlier on the television program, and he kind of made it clear that the banking crisis never really ended. I mean, it just kind of, maybe the effects of that sort of subsided, but it doesn't necessarily mean that everything had been resolved. And I think Moody's and that downgrade today, and not just the 10 downgrades, but remember, it was really the other, 17 banks that they had on that list that are now sort of basically under watch. I think that was the real issue.
Katie, this is a question for you. I mean, it's like what caught people so off guard here with this downgrade? I mean, we knew the banks were under stress. We knew that this was going on. We know that their balance sheets are being devalued because of higher interest rates. Why were investors so surprised?
I think it was just a reminder that this is a slow motion story. It's not going to play out in a couple of months. But I do want to say on KRE, it is off by 1.5% still, but that loss was as much as 4.5% earlier today. So it's pretty amazing that it's been able to claw back this much. Imagine if it goes green by the close. I don't know what happens.
Yeah, right, exactly. Well off its lows, but it does feel like a little bit of a slow bleed when it comes to what's going on in the banking sector, and it's a reminder that, we're not out of the woods yet.
Well, it is also CPI week, and there was a really interesting story on that theme on the terminal. If you take a look at online U.S. prices, this is from Adobe, it showed that the cost of goods sold online in the U.S. fell 1.6% in July from a year earlier. That's the 11th straight decline. That was led by categories such as appliances, furniture, and bedding, but the prices of groceries and non-prescription drugs continue to increase, actually.
Yeah, this has been kind of the trend for quite some time, and I think a lot of that maybe has just to do with supply and demand, right? I mean, you're mentioning appliances, a lot of these sort of big consumer durables that you don't necessarily need to buy again. If you just bought a washing machine 2 years ago, you're not in the market for one now unless you bought a really bad
maybe you didn't get that extended warranty that they were trying to sell you. But that's exactly what I was going to say, Romy. I mean, the things that you buy each and every week.
It's so great to see Carol. She's
relaxed.
She's so relaxed.
Really miss you, Carol.
I did actually. Don't tell her I said that. But
it's good that you didn't come back on a Monday.
I heard nothing. Yeah, exactly.
Yeah, Tuesday's a good day to come back from a nice long vacation.
There you go.
The only thing I will say, I agree with groceries. I had somebody tweet at me and they're like, "What is it?" I check out and everything's like $10, $12, and I feel the same way when you check out. It's really very expensive. So we'll see if those numbers come back. Romaine, thank you.
You're welcome.
All right, we'll see you back in less than an hour's time.
We'll see how it goes then.
Yeah, I might have to go on vacation again. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we do it all. We're going to count you down to the close on this Tuesday. Join us at 4 p.m. Wall Street time for Beyond the Bell. Up again, and I think we've been on such a run. I was sitting in the newsroom, Tim, and just looking at, again, a reminder, NASDAQ 100 up nearly 40% year to date. S&P still up around 16% year to date. So even if we see a little bit of a pullback, some perspective in terms of the bounce back we've seen at least this year after what was a rough year last year.
You know what they say, Carol? When in doubt, zoom out. So thanks for that context. But I also have a question.
Wait, when did you become a marketing executive in my absence? A little branding there.
But I guess my question is whether this is something that's expected and technical, or with the bank's news that we got today, the trade news from China that investors are dealing with, is this something bigger that investors need to be worried about? Because it doesn't always just go up.
No, it doesn't. And yields, we've seen quite a swing in the last 24 hours. You have big treasury auctions too, a lot of new supply coming on. So let's get to it. Let's make some sense out of it and what you need to know about today's trade. Bloomberg News chief correspondent for global macro markets, Liz McCormick, with us on Zoom in New Jersey, and then right here in our Interactive Brokers studio, Bloomberg News deputy team leader for U.S. equities, Jess Metton. Jess, I want to start with you. Talk to us. Quite a bounce back if you look at the equity trade, although I feel like it's a Treasury Day story. We're going to get to that in just a moment. But equities set the tone because we have definitely come off our lows here.
Yes, and especially when you're looking at what's happening more broadly in the stock market. I know you've talked so much about what's been happening in the banking sector as well as the financials, but more from a perspective of coming into August. I mean, this is the second worst month historically, seasonality-wise, if you look at the SEAG Go function in the terminal, right behind September. So coming into this month, not only was seasonality a headwind, but you were just pointing out, Carol, about how much the NASDAQ 100 has been on a tear this year.
My 401k is not up 40%.
No, exactly. And especially when you think
about
on
that strategy, apparently.
What's been happening with these chip names specifically this year, that's been a huge part of the bump that we've seen in the NASDAQ 100. If you look at the SOX, the Philadelphia Semiconductor Index, that's up about 45% this year. It had lost more than a third of its value last year. So not surprisingly, when you think of names like NVIDIA, which is reporting on the 23rd. Right. So we still have those earnings coming up with the last of the Magnificent Seven. But a lot of this has to do with also the positioning coming into this, and then the huge run-up we've seen in these more tech and growth-oriented corners of the market. So when I've been speaking with my sources, a lot of them have been using reasons as, say, excuses like this to take some profits so that once the valuations come off of some of these loftier stocks, they can come back in and buy.
People do take profits, actually. We got to talk about the Treasury trade.
And for that, let's bring in Liz McCormick. Carol already introduced her, but worth introducing her one more time. She's Bloomberg News chief correspondent for global macro markets. As Carol mentioned, Liz, this is absolutely a story about the bond market today. It's a Treasury story. Give us your interpretation of what's going on, because when I see the yield on the 10-year fall, 10 basis points in a 24-hour period, there's a story there.
Yeah, it's been pretty mind-spinning. And Carol, my 401k is not up 40% either.
You guys got to go to the. You guys got to invest with John Authers. He runs Hindsight Capital.
I feel like we're fairly intelligent people.
I know, I'm smart. But,
you guys just didn't go all in on Nvidia.
I guess not.
No.
I guess not.
Yeah, we missed that trade, but yeah, the bond market has been all over the place, and today, like you said, its yields are down, and we had the first of this big wave of auctions you guys have been mentioning, and the 3-year went really well. I mean, to be honest, that was the one of least concern for folks because it's the shortest duration, and Thursday we have the gummed up thing of a 30-year auction coming after the CPI, which we don't know how a CPI will be. But yeah, the Treasury saw really great demand at the 3-year auction, and that helped bring yields down after the fact. The auction wrapped a little after 1. So yeah, I think the market, like Jess was talking about positioning, we have a lot of that going on too, because we got the kind of speculative leverage accounts are short. So if yields start going down too much, then you see some short covering. And then we saw last week yields just take off. So I think what I keep getting from investors is just that the only thing they know for sure is that volatility is going to persist. They don't see it going away for a while.
That's what I wanted to ask you, Liz. Is it a case of just volatility? We're back. I mean, I feel like you go back a few months, right? We were constantly, I feel like day-to-day or week-to-week swings were pretty dramatic. But is it a case of, are you seeing signs in the Treasury trade of this higher for longer, narrative we keep, it feels like, getting from various Fed members, and certainly from Jay Powell?
Right. So we have this mix, like everything. Like today we had 2 different Fed officials, saying we're probably about done, and even talking about like what would cause easing next year. Another saying, more to do. So the hawks are fighting the doves a bit, which is normal. But I think for the bond market, for a while, it seemed like, and we probably talked about it. Oh, everyone thought we saw peak rates in October. Right. The worst is over. And then we all kind of got slammed, partly because of the combination of the extra supply. We knew supply was coming, but Treasury announced more than we thought. Fitch downgrade kind of caused, as we know, gyrations. And I think, so the Treasury, and then the BOJ we had last week, right, kind of tweaked the yield curve policy a bit. So I think the bond market felt like, oh, it's more of a two-way trade. Could rates keep breaking higher? Things have come off the boil today, but I don't think anyone is so willing to say the worst is over, even if the Fed might be done, because like you said, Carol, if the higher for longer camp wins, then staying at over 5% on the funds rate is pretty high, right? And on the flip side, we have this kind of, what are we calling it now? I'm losing track. Let's just say the recession people are getting pushed off into next year, and there's the soft landing gang is gaining traction. So that's not good for yields, right? It's good for the economy and jobs, but not as much for the Treasury yields.
Yeah, I mean, when Jess and I were anchoring together yesterday, Carol, our drive to the close guest was really on team. Like, hey, we're not thinking that there's actually going to be a soft landing. We're 65%.
When everybody jumps in on that bag, man, it makes me a little nervous.
That's exactly what I said to Jess. I was like, well, maybe this is sort of a contrarian indicator here, right? That everybody's sort of getting on that ship. So Jess, let's talk a little bit about what happens later this week when we do get CPI and what your sources are telling you about what could do to the equity market, if it could be one of those surprises that could change the way the Fed is thinking about what happens in September at their next policy meeting, or the way that Chair Jay Powell talks about things in Jackson Hole later this month. What are you hearing?
Right. So we still have 2 CPI reports before the Fed decision on September 20th, as well as 2 more PPI reports, producer prices on Friday, and then, of course, another, when you're looking at what's happening with consumer prices, as well as their PCE indicator, the Fed's preferred gauge. So when you're looking at CPI, we just had the employment costs index recently as well, and that was moving in the right direction. It's more quarterly, but that is the key gauge that Powell and other Fed officials look at to gauge what wages are telling them. And that's also is something that Powell had flagged back in December of 2021 when he first dropped transitory a couple weeks before before that. So we know he watches that. It's going in the right direction. And when I'm speaking with my sources, they do feel like clearly inflation is ebbing in the right direction, but it's more as far as when it comes to more of a corporate America, how companies are dealing with those margin pressures. It looks like the worst of the pain was actually in the fourth quarter of last year when you look at Bloomberg intelligence data, but it depends on the type of sectors and companies. We are seeing improvement on the consumer side and discretionary, but specifically more so in technology. When you think of the cost-cutting efforts like Meta and some of its counterparts that had this aggressive hiring in the pandemic, those are seeing it, but how much further can that continue?
Right.
And that's going to be a big question moving forward.
Going back to my $19 deodorant, I did not buy it, or $7, dozen of eggs, and my sister-in-law.
The egg prices are coming down.
Well, we were on vacation. She's like, yeah, I'm like, we got to do it. Like, it's just crazy. Hey, so Liz, go back to the auctions. As you said, the expectations were the shorter durations. Yeah, they're going to do probably okay. As we get to the longer durations, Wednesday, as you said, 10-year, Thursday, the 30-year, 23 billion then, Wednesday, 38 billion. What should we be watching out for that might give us some indications about, I don't know, something more significant in terms of the Treasury outlook?
Yeah, well, you know how in the auctions they usually have what they call a concession, like the market will kind of back yields up a little bit to kind of entice investors. Now, I'm curious to see what happens. Every overnight is like you wake up to a whole new world. Like, do we come in tomorrow, our yields back up? Because that's kind of good for the auctions because, a little bit higher yield entices investors. If yields keep coming down like they're, right now, the question is, do people, like we were talking before, start thinking, oh, well, jeepers, maybe I missed it again, I buy anyway, or the auction might not do as well if say, the 10-year goes below 4% or something, So I think depending on the yield level will matter a lot. Because, I just think there's so much uncertainty as if they're going to get a better chance, Like, you think of the front end, even if the Fed hikes one more time, the front end can't go probably that much higher. But the long end, there's just so many mixture, variables pushing things around. And even looking into the future, like, say these no landing camp wins, Fed officials have made clear that they may have to cut rates. They wouldn't call it easing next year anyway. So, bond calculus is trying to figure that out just to keep from not getting too restrictive, right? If inflation comes down and all else is the same, they kind of want to bring the nominal funds rate down a little bit to not cause, too much pain. So I think the bond market is trying to get, figure out so many variables that it's just tough. But I think tomorrow if hot yields are higher, that might bode well for the auction.
Let's just do what they do in Europe, right? They take the month of August off, and then we'll come back in September, we'll be closer to, the next Fed meeting.
This is like what they do in Europe.
Yeah.
We should just take a page from their book.
Just take a break. It's a little confusing. Folks, we'll get back to you in a month. Can we do that? No, probably not. Liz McCormick, thank you as always. Chief Correspondent for Global Macro Markets at Bloomberg News on Zoom from New Jersey. Check her out at McCormick Liz on Twitter, and check out Jessica Metton on Twitter. She is, of course, Deputy Team Leader for U.S. Equities at Bloomberg News. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ, all in the red. Bank stocks are lower. All 24 companies in the KBW Bank Index are retreating. We've got more on banks coming up in just a moment right here on Bloomberg Business Week. Robinhood Markets says it is cooperating with an investigation from New York's top law enforcement office into brokerage execution quality. This according to a regulatory filing from the retail trading firm. Shares of Robinhood Markets are down now by 2%. And sources tell Bloomberg Ryan Salem, the former co-chief executive of FTX Digital Markets, is in negotiations with federal prosecutors to plead guilty to criminal charges following the implosion of the cryptocurrency exchange. Right now, we have got Bitcoin up 2.5%, Bitcoin at 29,919. Stocks lower across the board, with the S&P right now down 22 points. That is a drop of 0.5%. Dow Jones Industrial Average down 164, decline of 0.5%. NASDAQ Composite Index down 123 points, a drop there of 0.9%. 10-year yield 4.01%. We have got the 2-year yielding 4.74%. Spot gold down $10 the ounce to $19.26, down 0.5%. And West Texas Intermediate crude up 1.3%, $83.02 a barrel. Well, as for the market backdrop, what is ahead? Mira Pandit is global market strategist at J.P. Morgan Investment Management.
The market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize, but the market is already sort of looking a little bit beyond there. And that's a good environment for diversification.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Among the names scheduled for after the closing bell today, we will be hearing from Rivian Automotive. Rivian shares, they're up right now by about 3.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Carol Massar along with Tim Stenovic live in our Bloomberg Interactive Broker studio on YouTube and Bloomberg Originals here on Bloomberg Business Week. So we just talked with the team, right, Tim, about KBW Bank Index down almost 4% at its lows today, still down about 1.3%. So we've definitely bounced off the worst levels of the day. Same thing for the S&P Regional Banking ETF. We're talking about the KRE, which was down about 4.5% at its lows, now down about 1.25%. And of course, this was all following Moody's lowering its ratings for 10 small and mid-sized lenders and talking about downgrading maybe some other firms. So a lot going on, reminding us that maybe we ain't out of the woods yet when it comes to banking here in the U.S.
Yeah, I think that's certainly fair to say. The concerns are higher funding costs, potential regulatory capital weaknesses, rising risks tied to commercial real estate. Those are among the strains that are prompting the review. That's according to what Moody's said late yesterday. With more, very pleased to have with us Bloomberg Intelligence senior analyst for U.S. regional banks, Herman Chan, who joins us in the Bloomberg Interactive Broker.
We actually call him King of Regional Banks. I didn't know if you know that, Tim.
Was he anointed king in March? Is that what happened?
Coronation happened, yeah.
Okay. King of Regional Banks. I'm sorry, sir, I bow down.
You got to get the title right.
Well, it's good to have you. I was nice to get to meet you a little earlier, too, in person finally, because I was gone for the regional bank crisis, but I guess I get my own little mini crisis here.
You do. It's our gift to you.
That's the question. I mean,
you're getting the aftershocks.
So to what extent is this tied to what we saw in March?
Yeah, I think it's double-barreled in terms of the fallout from the banking failures from SVB, Signature, First Republic, and also it's the aftermath of the higher rate environment that we're currently operating in. The Moody's reports noted the higher funding costs, as you articulated. So that's really crimping the profitability of these banks. And also you're seeing a tougher regulatory environment. The Fed is already proposing tougher capital rules and expected to offer some tougher liquidity rules for the regional banks. So these are all things the banking space has to contend with, and the upshot is just weaker earnings and weaker first line of defense against the expected potential higher charge-offs from commercial real estate.
It's a little puzzling to me because, and I mentioned this on with our TV colleagues a few minutes ago, this shouldn't surprise anyone.
Right. So it shouldn't surprise
We've been talking about the struggles in the commercial real estate market for months,
right,
and rates have been high for better part of a year.
Right. It shouldn't surprise folks. We've been writing about all these issues ever since April and May. So it's been on the radar screen of all the folks that cover regional banks and write about them on a daily basis. I guess it's just more of a recall that the stocks have rallied a bit ever since the May time frame, and this is just a call that's saying we're not totally out of the woods yet, but in my view it does seem like the issues facing the banks that Moody's articulated should be pretty manageable.
All right, so March, April, May, June, July, August, almost 5 months. 4 or 5 months later. So I don't know. How do I have mixed feelings coming if I go back to the great financial crisis and when finally the ratings agencies kind of caught up to all that ailed us.
Right.
So how are we as investors supposed to kind of be like, wait, is most of this still priced in?
Right.
Or is it just, again, like you said, hey, whoa, slow down a little bit? Like how do you read a call like this?
I just go back to some of the clients that we've talked to today, and they've mentioned that there isn't really anything new in terms of the call, but it's just reiterating the fact that there are a number of issues and hurdles and headwinds that the banks need to contend with going forward for the next 6 months, a year, 2 years.
What are the banks that you most specifically keep on your radar? I think about, and just to kind of give you some background, Tim, like I feel like we were leaning on Herman constantly during the regional bank crisis, and what was interesting is I felt like it was a few names that kept popping up. Obviously, Silicon Valley Bank, and kind of the ones that really were on everybody's radar. But there were others, whether it was PacWest, and obviously we know what happened there. But what are the ones you now keep on your radar, either out of concern as possible acquisition targets, or what?
Right. So really, in terms of acquisition targets, the only bank that really is immediately on the radar screen after the PacWest announcement is Home Street. HMST is the ticker. Bloomberg wrote about them potentially shopping themselves a couple weeks back. So that's the one that's still sort of floating out there. But the others that were potentially, tougher, hit a bit harder during that banking turmoil earlier in the year, like a Western Alliance, they've actually done a really solid job of shoring up their balance sheet and improving their capital ratios, improving their deposit base. So not expecting anything there going forward, because I think they've laid out a very credible path of regaining that balance sheet strength that they lost a bit in March.
What's a little surprising to me, Herman, is that in the S&P 500, regional banks are down 1.2% as a whole, but diversified banks, the huge ones, the JP Morgans, the Bank of Americas, those are down 1.1%.
Right.
Is it connected? Is it related? Why are they getting hit too?
I think it just shows the fact that there are headwinds across the group going forward. The capital ratios issue and the tougher regulatory environment is something that all of the banks, the largest banks in the United States and the regionals, will have to contend with varying degrees. And we're actually not sure yet.
Citi's down 1.5%. JP Morgan down about 2/3%.
Down 2%.
Yeah, and off their lows, but nonetheless, these are the ones we think, okay, we should be okay.
Yeah, that's right. They should be fine, but we're just in sort of some uncertainty involved in what's going to happen next in terms of how these capital rules really shake out.
Is the real estate exposure still a big deal? Like, what's the top of mind? Is it the interest rate exposure? Is it real estate, commercial real estate, office real estate? What is it?
Over the next couple quarters, it will continue to be the deposit costs and how fast they rise, and the mix of deposits. Will they continue to remix into higher cost forms like CDs? So that's the earnings pressure that banks are facing. Over the next couple years, you're going to see commercial real estate become more and more of an issue. Everybody's talking about it now, but the actual repercussions of credit losses really hasn't shown up yet at all for the regional banks.
Because the loans aren't due yet?
Because the loans aren't due yet, and they can do a little bit of restructuring and kick the can down the road, that sort of thing. So there's some maneuvering that's happening and some tough conversations that are going on on today, but the actual losses just haven't hit. So that's going to take some time to really happen for the industry.
What do the data tell us, and what do you have at Bloomberg Intelligence that shows where people are keeping their money right now? Because if they're keeping their money in their traditional quote-unquote checking account, it's paying nothing.
Right.
But you can quickly move it to one of these neobanks, and
Right.
this was the problem during the March banking crisis. Everyone was like, wait a second, if I can get, 4.5% over at, whatever, American Express or Wealthfront or whatever,
Right.
name the neobank here, then I'll just, take all my money from my checking account there. Is that still an issue for the banks?
That's happening. So the longer we're in this higher rate environment, the tougher it is for the regionals, because inevitably your customer base will start to erode from the traditional checking accounts, and quarter by quarter, month after month, you're going to see those zero cost deposits continue to move to a higher cost rate, like a CD or a high yield savings. So that's something that frankly, the regional banks would love to see rate cuts, potentially later this year or next year, just to stem that tide.
We bow down to the king. Herman Chen, thank you so much. Senior analyst for U.S. regional banks at Bloomberg Intelligence here in studio. And as we continue to talk about the banking sector, we continue to talk about things like, in the crypto world, FTX. And just crossing the Bloomberg, Ryan Salome, this is a Bloomberg exclusive. He is the former co-chief executive of FTX Digital Markets, is in negotiations with federal prosecutors to plead guilty to criminal charges following the implosion of the cryptocurrency exchange. This is according to people familiar with the case of Just Crossing here, Tim.
Remember, there's going to be a Sam Bankman-Fried trial, too, coming up in October. So that's something to keep an eye on as well.
Yeah, interesting. So this story continues to unfold and different people involved with it. So he would be the fourth former FTX executive to plead guilty.
Yeah, after Gary Wong, Caroline Ellison, and Nishad Singh, who've already pleaded guilty to playing a role in the alleged multi-billion-dollar fraud at FTX.
More to come. We'll continue to monitor. Right now, though, let's get a check on the latest world and national news. Off to Dan Schwartzman we go. He's in our Bloomberg 1130 newsroom right here in New York. Hey, Dan.
Thanks, Carolyn. Tim, bad news for air travelers as domestic airfares will start to rise after mid-September. Booking app Hopper says the fares are expected to climb around 10% in November, December, that region, to an average of $283 per round-trip ticket. That's up from the current average of $257. International travelers, though, won't be seeing any relief as prices aren't expected to go down as they remain 59% above 2019 levels. Lawyers for Donald Trump are asking the judge overseeing the election conspiracy case to reject a protective order to limit public disclosure of evidence that has been requested by the special counsel. Bloomberg's Nancy Lyons has more from Washington.
Attorneys for the former president say the order would violate Donald Trump's First Amendment rights and is too broad. They asked the judge to only place limits on sensitive materials being disclosed. Former federal prosecutor David Weinstein tells Bloomberg Balance of Power it's now up to the judge overseeing the case. Tanya Chutkin.
She'll draw on her practice and procedure on what is traditionally done within her courtroom, within the district, and she will fashion her own order that incorporates much of probably what the government has asked for.
In Washington, Nancy Lyons, Bloomberg Radio.
Thanks, Nancy. During a speech in Philadelphia, Vice President Kamala Harris announced changes to labor rules that could give raises to construction workers working on federal projects. Harris says the Labor Department has updated the Davis-Bacon Act of 1931 that requires paying workers the prevailing local wages on public works projects. The new rule is likely to raise the wages of more than 1 million construction workers who are currently working on roughly $200 billion worth of federal projects. Critics do say the added cost will just make construction projects even more expensive for taxpayers. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Lots of red on the screen with the Dow, the S&P, NASDAQ, all declining. Let us head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
Good afternoon, Charlie. Stocks are in the red, but are well off the day's lows. The Dow is down 180 points, S&P lower by 25, with the NASDAQ sliding 135 points. The U.S. 10-year yield is at 4.01%, and small caps are down 10. 8 of the 11 main S&P sectors are trading lower, led by losses in consumer discretionary and materials, while health and energy are the top performers. Nasdaq Biotechs rise 25 points, transport slip 100, semis are down 60 points, while the VIX is higher by 2%. Leaders in the Dow, Amgen, Disney, and Caterpillar, while Salesforce, Goldman Sachs, and Microsoft are the worst performers. It's been a big day for obesity drug makers. Eli Lilly soared 15% to a record after boosting its revenue guidance, and Novo Nordisk rallied to an all-time high of its own after its weight loss drug cut the risk of heart issues in a study. On the earnings front, Palantir slipped after it failed to deliver a strong sales outlook, and Olaplex sank after cutting its sales guidance. Wrapping things up, look for earnings from Rivian, Lyft, and Bumble after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
All right, we thank you very much. Bailey Lipschultz it is. Bailey, we thank you. Now, just recapping S&P down 20, down 0.5. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, safe to say we thought the close was going to be a little bit different, certainly earlier today. We are well off our lows of the session on the equity trade. Still down across the board, Tim, but yeah, like I said, not as bad as it looked earlier today. And yields have definitely bounced a little bit off their low, especially the 2-year. But we're still looking at a 10-year at about 4.01, 2-year note with a yield of 4.75.
Okay, a lot on the agenda, Carol. We got with today's trade, right? We got the banks. You talked about the move in yields. UPS earnings, not so great. No. Some pharmaceutical company earnings, those were pretty good. We heard from a couple Fed presidents, one voting, one non-voting. The big question, what does it mean for tomorrow? What does it mean for the rest of the year? What does it mean for the Fed?
I am curious about clarity, and we've got a perfect voice to do it. Understands market cycles, has seen several, many, like us. Sam Stovall is CFRA's Chief Investment Strategist on Zoom on this Tuesday in Allentown, Pennsylvania. Sam, it is good to have you back, and I do really appreciate the way you analyze the market. We all do, and relate it to different cycles. So when you look at this cycle, what matters in a day where we feel like we had a dump of news on China, on Italy, U.S. banks, a lot of stuff going on? What matters?
Well, I think a lot of that stuff matters, Carol, but good to talk to you and Tim today.
Yeah.
I think investors have been getting the feeling that maybe we've gone a little bit too far with the market advance. The S&P is up 28% since the October 12th low. The NASDAQ was up 46% through the end of July. And being a reader of the Stock Traders Almanac and doing my own research, realizing that August is the third worst month of the year, second worst for the NASDAQ, but then we have September, which is the worst of the year for both indices. Just from a seasonal perspective, maybe we are entering into a digestion phase because let's face it, the NASDAQ was trading at 26% above its 200-day moving average, which is a statistical extreme.
So you're saying this is more about seasonality and technicals than actual fundamentals?
I wouldn't go that far because when you look to the fundamentals, you're seeing, yes, the second quarter earnings did come in a little bit better than expected, meaning they fell a little less than was anticipated. 9 of the 11 sectors are actually showing an improvement in what will probably end up being the conclusion for the second quarter versus their June 30th estimates. And when you look to 2024, we're still focusing on about a 12% year-on-year rise for the S&P 500. So should we finally get the last rate hike, I think investors will be feeling good because we tend to see a hike, skip, and a jump that takes place after the Fed is finally finished.
What about, Sam, about the impact of potentially, it seems like the one narrative that feels fairly consistent is higher for longer from the Fed, so that even if they stop raising rates, they're going to keep them there for a while. What's the longer-term impact of that on the equity trade?
Well, I think you're absolutely right that normally there is a 9-month differential between the last rate hike and the first rate cut, and the market traditionally has risen about 13%, along with all sizes, styles, sectors, and 99% of the sub-industries. But if the Fed decides to keep rates elevated for longer, I think they will be doing so if we do not end up falling into recession, and if we do end up with a soft landing, which is exactly what they would be hoping for, because the higher rates would ensure that we would end up with a decline in the core PCE that will likely stick around rather than simply touch the low point and then bounce once again. So I would tend to say that the Fed would be very happy to keep rates higher for longer. But if we don't end up getting thrown into recession, that would be icing on the cake, because if we did fall into recession, the Fed would have to reverse course and start to cut.
But is it more likely that we fall into recession if we keep higher for longer? Or will investors see that like, okay, we're done. We're just kind of marking time until the Fed feels comfortable enough to start cutting rates?
Well, I think actually you could say yes to both of those partial questions. First off, if the Fed does raise rates for longer, then it increases the likelihood of recession. But at the same time, if the investors realize that the Fed will be cutting interest rates, then that could be a reason that the recession might end up being shallower than anticipated. I mean, when we look to all of the other historical reference points, we should be in recession by now. Whenever inflation has been above 6%, we've fallen into recession. Year-on-year declines in leading economic indicators have signaled recession. Earnings recessions have signaled economic recessions, and so forth. So basically, this would be one of the few times in which a majority of the fairly reliable indicators did not work.
So it raises the question. Well, actually, I want to go back to something that you said that I've been thinking about. A hike, skip, and a jump. That's what you said, right?
Yes.
So we've had the hike, we've had a skip, but we had another hike. Were you anticipating? So where does the hike? Where does this end, in your opinion?
We think it ends in September. They will hike rates one more time, and then they will be on hold until 2024. Our expectation right now is that they probably will start to cut rates by the end of the first quarter or into the second quarter, and then gradually do so maybe 2 or 3 times next year. But that certainly is dependent upon the data. Maybe we do end up staying higher for longer. But even when we have had a hike, a skip, we've had the jump in the markets, even with a subsequent hike in interest rates, the market continues to rise primarily because they realize that the end is near. The end of the hiking process is almost over.
So, Sam, I want to go back to what you said. You know, you talked about earnings recession usually precedes an economic recession. There are other indicators out there that all point to that we're going to get into a recession. And then you kind of said, but this could be potentially one of those times when the regular signals don't bear out. Do you actually believe it could be different this time around? And forgive me, I've only got about 35 seconds left.
Okay, I hate to say this time is different. I do think that maybe we do end up with a recession, but it ends up materializing in 2024 rather than when most people had been anticipating it to occur in the second half of this year.
Okay, so in case we get there, but just different in terms of timing.
I think so. Add to that all of the plethora of inverted yield curves, and the weight of a potential recession is overwhelming.
All right, cool. Great. Oh my God. So glad we got some time with you. Sam, be well. Sam Stovall, Chief Investment Strategist over at CFRA, joining us on Zoom in Allentown, Pennsylvania. We've got about 10 minutes left in the trading session, and we are pretty much at our best levels of the day on the equity trade here.
Yeah, S&P 500 only down 0.4%, the NASDAQ down 0.7%, the Dow Carroll down 0.4%.
And all you bulls were worried.
I mean,
I'm only kidding.
Still a lot of red.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Robinhood market shares, they are down now by 2.5%. Robinhood says it is cooperating with an investigation from New York's top law enforcement office into brokerage execution quality, this according to a regulatory filing. Italy's right-wing government shocked markets today after imposing a tax on the nation's banks. Bloomberg finance reporter Sonia Cerletti in Milan has more on the levy that caught banks off guard.
This is a tax on extra profits of lenders generated by higher interest rates, which boost the bank's net interest income. Specifically, the Italian government was said that they want to apply a 40% levy on this extra profit on NII.
Cerletti says the impact was swift, wiping out around $10 billion from the market value of the country's lenders. Palantir Technology shares are declining after earnings. Palantir is the software maker that has for years sold artificial intelligence-powered programs to the government. It sank by the most in 8 months after issuing a sales forecast that disappointed Wall Street. Palantir down now by 6.2%. Beyond Meat shares plunging after the plant-based burger company said it is unlikely to hit its goal of becoming cash flow positive in the second half of the year. The company also trimmed its sales outlook. Beyond Meat now down by 14.8%. And those are the top company stories at this hour. I'm Charlie Pellett. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, just under 5 minutes left in today's trading session. Just heard from Charlie breaking down the numbers in the trade. We're just rolling over our best level of the session when it comes to equities. We've seen quite a turnabout when it comes to yields. Yeah, a lot coming at us right now.
Dip buyers coming in.
Yeah, it looks like it, right?
That's what it does look like.
Were you calling me a dip? What was going on?
No.
Just checking.
Just this isn't an article on the markets wrap on the Bloomberg terminal.
Dip buyers, they do that, right?
Oh yeah.
Something goes on sale, why wouldn't you?
It depends on if they consider this actually on sale.
Like,
Sam Stovall said things are still pretty expensive, right?
He makes a good perspective, puts us, what did you say? What was that thing you said about stepping back or whatever?
Yeah. It was when in doubt, zoom out.
What is that?
It's like when you look at the chart.
But where did that come from?
Katie Greifeld said it.
Oh, Miss Greifeld.
Yeah, I'll have to ask her where she got it.
She's selling hats and T-shirts on that one? All right, we're going to talk about the trade with our TV colleagues in just a moment. In the meantime, just looking at some stories that definitely are caught our attention. This one on banker bonuses. Merger advisors' bonuses likely to tumble this year as the businesses remain stagnant. Though asset management execs, they are going to see modest gains. This is coming from Johnson Associates. So what are we talking about? Those who are advising on M&A transactions probably see payouts slump as much as 25%.
I mean, if there's not M&A
is that one of those?
Yeah, it is. If there's not M&A happening, then they're not going to get paid.
And then there were those years, right?
Sri made the point yesterday. We had him on the program talking about Goldman Sachs and about what banking was like in 2020 and 2021. And it's a far cry from being so busy that the interns could write, and first-year associates could do PowerPoints about how stressed out they were. And nowadays, it's like, okay, can I keep my job?
There were some record years.
Exactly.
Of
but that's how it works.
Or near record. Right. You win some, you lose some. Right, exactly. So anyways, and this is among our most. Traders, by the way, also in for a disappointing round of payouts. Incentives dropping as much as 10%. Certain fixed income businesses, though, are likely to outperform according to the report. And we talked a lot about, I feel like the fixed income world has definitely had a readjustment, if you will.
Yeah, it was last week was a week that was all about yields, Carol. It's a week about bonds.
All about yields.
I know.
Real yield?
Real yield, nominal
Jonathan Farrow,
yield.
where are you when we need you?
It's Katie does it now.
Too. Oh, that's right. Oh, that's right. I'm sorry. That's right. Katie does it.
When in doubt, zoom out.
I know that. When in doubt, zoom out. We're going to zoom out, guys. Tell you what you need to do. Break down a bunch of earnings, including Rivian and Lyft are crossing. Right now, it is time for Beyond the Bell.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here they'll take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenevec in the same room at the same time for the first time in a long time.
We actually like each other.
Bloomberg.
Funny how that works.
We welcome all of our Bloomberg audience across all of our platforms here. Carol Masser.
Yes.
Looking at a market still red across the screen, but as we were just talking about on TV, that could have been a lot worse. It looked like this was going to be an ugly day. You had significant percentage declines across the board, still in the red, but only a fraction of a percent for the major indices each.
Well said. I was thinking of listening to Surveillance this morning before the market opened. They were talking about futures. We're going to be down, and we definitely looked looked a lot more negative earlier in the session. Having said that, something that has really stayed as an outperformer today is the pharmaceuticals. They're still up about 4%. I'm going to talk about it a little bit more in just a moment, but you had Eli Lilly boosting its revenue guidance. You also had Novo Nordisk talking about Wegovy, and so there's been a lot of optimism when it comes to some of those big pharma names.
Yeah, like you guys were saying, it could have been a different day. I mean, the S&P 500 was down as much as 1.2% earlier in the day. The NASDAQ was down as much as 1.7 today. Scar, I'm wondering if, investors were coming in and buying the dip, or if they got a little spooked and they took a step back and said, wait a second, this, our worries are confined to one sector.
Yeah, it just looked like the bank's downgrade from Moody's was a repeat of the worries that existed in April and May, but nothing really new there. I mean, people had already kind of factored all of that in.
Yeah, absolutely. But I think what seemed to rattle the market out of that Moody's report was really kind of some of the forward-looking statements. The idea that I think what everyone thought was in the past with regards to the regional banking crisis, at least in Moody's view, they're saying still up ahead in the future. And I think that maybe is why. And also, it wasn't just the banks that got downgraded. I think it was a lot of the bigger ones that got put on watch that rattled some folks. Nevertheless, as we talk about a market that opened lower by more than 1%, and in fact, some of these indices were down 2, 3, 4% on the day. Now we're only looking at fractional losses. The Dow Jones Industrial Average down 4.5%. The S&P 500 down 0.4%. The NASDAQ Composite down 0.8%, and the Russell 2000 is going to finish out the day down by about 0.6%.
All right, and let's just take a quick look at the S&P 500 in particular. We're seeing, just pulling it up here, 153 names in the index, actually higher for the day, 349 to the downside. So we did see a bit of a clawback, if you will, in a lot of these names in that index.
All right, let's take a look at the industry groups, because when I came in this morning, it was pretty much all red. There was one group in the green, and that was the pharma stocks because of Eli Lilly. You can see how that's shifted a little bit here. Pharma stocks still at the top of the heap there, powered by Eli Lilly. Utilities led by Duke Energy moving higher, and notable that Apple snapped its 5-day decline. So tech hardware also finishing up in the green. On the downside, you have chip makers, healthcare equipment stocks, and insurers, each off by more than 1%.
All right, so as Scarlett mentioned, pharmaceuticals really a big standout here and top among some of the major averages. Novo Nordisk, the ADRs up 17% in today's session, just finishing off their best levels of the session. It's blockbuster obesity medicine Wegovy reducing the risk of heart attacks and strokes in a highly anticipated study. So you saw this stock off and running. It also sent shares of Eli Lilly higher, which were up about 15%, top in the S&P 500, and they also remain raising their revenue guidance for the full year.
Yeah, getting some earnings here after the bell, awaiting lift. Rivian actually crossing the wire right now. The company saying that, well, its adjusted loss in the most recent quarter coming in at $1.08. The street was looking for a loss of $1.37, so at least that appears to be a bit of a beat there. Their full year production forecast now at 52,000 vehicles. Now that is slightly higher than what it had said before. It had said that it was going to produce about 50,000 vehicles this year, so a bump up of about 2,000 vehicles for the full year. Also on a full year basis, the company saying that its adjusted EBITDA will still be a loss, but a somewhat narrower loss than what it forecast before. $4.2 billion versus a loss of $4.3 billion that it had projected before. Cash and cash equivalents on the balance sheets right now, guys, $9.3 billion.
Yeah, taking a look in after hours right now, shares of the stock up by close to 2% as we speak. The company giving some highlights in its investor letter, saying that the second quarter reflects strong financial and operational progress. It's continuing to ramp production, working on efficiency, and they're introducing new technologies to enhance the custoer experience.
I've seen these trucks everywhere now.
That's
like,
what
remember
said.
they were,
She
it was
just
like a
said that
unicorn.
when she came
You would
back
just see it.
from vacation.
You see it on New York City streets?
Yeah, well, I should point out, I say it on New York City streets. I should point out, too, I was just in Chicago a couple weeks ago, and they were everywhere. I don't know why, for some reason, but...
I see them outside of the city, too.
You're definitely seeing that production, and just anecdotally, you're definitely seeing that production really start to kick in, or at least the deliveries, I should say.
I was out in Connecticut. I saw them. I was like, oh, I've never really been up close to one, to be quite honest. And there they were. What's interesting is the stock's up about 2-3% here in the aftermarket. You know, we've talked about the short squeeze. Anybody who was trying to short this one, it was a really difficult name to do it, and that's something to think about what?
I am curious, do you think that they can kind of thread this needle? Because everyone, I think of all the sort of Tesla competitors, meaning the pure EV kind of startups, this was the one that everybody said kind of had done it right, in terms of their cost structure, their manufacturing operations, and that they can maybe replicate the success that Tesla had.
Yeah, I mean, I think that was certainly the bet when it went public, and that's why we saw what happened with the company's stock. I think the question is, like Elon Musk says all the time, it's difficult to build a car company, and an American car company hasn't actually succeeded, in half a century here in the U.S. That said, legacy
it's a little
automakers...
easier if you don't spend all day on Twitter.
It's called X now?
Yeah.
But the truth is, the legacy automakers too are creating vehicles that are EVs that are nothing to shake a stick at right now with the F-150 Lightning, and what Chevy's doing as well.
Well, what it comes down to right now is that Rivian is not a one-trick pony, but it's a niche player, right? I mean, they're focused on EV trucks. They don't have to worry about sedans or anything else, so they can focus on making their product really well and scale that slowly. But they don't have to worry about all these other things, including things like X.
Okay, well, we're going to keep an eye on earnings as they continue to come. We are expecting a few more, including Lyft. In the meantime, let's take a look at some of the companies that moved lower on the day today. Carol had the gainers. I'll go through the decliners right now. The regional banks taking a hit today. Fifth Third Bank down 1.9%. This after Moody's lowered its rating for 10 small and mid-sized lenders. Said it may downgrade some more major banks. Fifth Third, in fact, wasn't even on the list except for the negative outlook, and that's why we saw Fifth Third move lower. It wasn't just the regional banks, though. Bank of America fell 1.9% today, Romaine, and I know there's some more earnings coming out. Let's get
I'm going to interrupt you here. Lyft earnings crossing the wire. The 2Q numbers coming in on the revenue side, looking at about $1.02 billion. That's right on the nose of the average of analyst estimates out there, surveyed by Bloomberg. Here's the big beat, though, the big miss, I should say, on adjusted EPS in the second quarter, a loss. Excuse me, just let me correct myself. I just want to make sure I have these numbers right. They have a adjusted EPS profit of 16 cents a share. The street was looking for a loss of 1 cent a share, so a beat there as well. 16 cents a share in EPS versus the street estimates for a loss in the quarter of 1 cent a share here. Active riders in the quarter coming in pretty much on the nose, right around 21.5 million. And here's your forecast going forward. Third quarter revenue, 1.13 billion to 1.15 billion. The bottom of that range is higher than the average of analyst estimates here. And adjusted EBITDA for the third quarter, they're saying that they can post EBITDA of 75 million to 85 million on an adjusted basis, of course. That would be almost double street estimates.
That's a big deal.
It is a big deal. And remember, we just had this conversation a few days ago when Uber came out and posted a profitable quarter. And we know Uber's kind of been on that trajectory for a while. The big question is whether Lyft would keep up with them.
Yeah, well, hopefully they have something more to say when it comes to their plans going forward strategically. I just want to jump over to Take-Two because that company also reported earnings as well. For the first quarter, it was a miss, whether you were looking at the bottom line or the net bookings. EBITDA, adjusted EBITDA of $105 million, missing the mark. The consensus estimate was for $142 million. Also for net bookings, $1.2 billion, just slightly below the consensus estimate. For the outlook, Take-Two sees net bookings of up to $1.45 billion, which is less than the consensus estimate of $1.46 billion, even though for the full year, it does reiterate its net bookings outlook. We know that there did not have a new video game release this past quarter, so people are looking ahead to what it says for the coming quarters.
If it's okay, I want to go back to Lyft. Just looking through the press release here, the company's chief financial officer, Aaron Brewer, saying the rideshare market is growing. We had a solid second quarter, and we have strong ride momentum going into the third quarter and the back half of the year. So there's some outlook and some visibility. Team is unified and focused on delivering great experiences for drivers and riders. But remember, they've been doing some cost-cutting efforts. They cut fares. There's a lot going on at this company, and I think expectations were low, so definitely some outperformance here.
Well, we've spent the last couple of weeks talking about returning to work, and David Risher, the company's CEO, actually calling out returning to the office and commuting as one of the reasons for the good quarter, Romaine. Between summer travel and return to office commuting, folks are getting out more every day and loving the Lyft rideshare experience.
This actually came up during the Uber conference call because this was a similar thing. Like, is there a correlation between whether we're going back to work and whether we're using services like Uber and Lyft? And I guess Lyft is saying, yeah.
All right, so apparently we're using...
Not in New York, though.
Lyft and Uber.
Too much traffic.
We're also dating, apparently, because...
Yeah, nobody drives.
Nobody drives. Nobody drives here. Too much traffic.
Did you guys even hear me?
We're just like doing
hey,
the best.
Carol's talking about
Carol's
dating.
back.
Can we talk about dating? Bumble's
What
up
happened
about-
with dating?
Bumble's up about
Bumble.
3.5%.
I didn't know you were in the market.
Oh, well, overseas I am. That's where they're expanding. Apparently.
Wow.
All right.
All right. I hope John's
All
not
right.
watching.
Let's go. Where's Mr. Master? Is he on the phone?
Sorry, honey. All right, that's a wrap. Our cross-platform radio, TV, YouTube, and Bloomberg Originals, folks. We call it Beyond the Bell. We will all see you tomorrow. From our team, our TV colleagues, and I'm like, wait, earnings? I thought we were done. I thought I could
No.
take my vacation and be
I
done.
said yesterday, Carol, it's always earnings season.
It's always earnings
It's
season.
always earnings season. It feels like that.
Well, it's
not
also-
bad. No complaints, though. Gives me something to talk about.
I know. Bubble and bubble.
Better than, hey,
3.5%.
I'm not going to say it's better than talking about the weather.
I was,
it's not.
I was
okay?
just going to say, we can always talk earnings and we can, nicely done.
Thank you.
Well
Great
done.
minds think alike, right?
All right, so let's get to it because July was officially the Earth's hottest month on record. And I got to say, last night coming home from Connecticut, my husband's like, okay, here's your window. It was a 3-hour drive. He's like, here's when I want you to go home because I'm worried about you like driving in this crazy weather.
It sounds like he's a pilot.
He was a pilot. He is a pilot.
Well, that's probably why he gave you that advice. Okay, here's the window. Here's where you can
That's
leave.
exactly what
Watching
he
the
did.
storm front come in.
This is where I want you to go. All right, so let's talk weather because it is not just something we talk, hey, we're at a dinner party, what about the weather? It's really serious. So back with us is Bloomberg News sustainability editor Eric Roston here in our Interactive Brokers studio. I do, right? Remember you'd go to a party and you talk about the weather? I mean, it really matters now.
It does, and
Or it has for a while, probably.
Well, it has for a while, and it is curious. When I'm in the elevator or you're on the street and you hear people talk about the weather, as everybody does, there's still no recognition of why it's so weird. That just sort of anecdotal lack of curiosity. I find
Can we say
puzzling.
together 2 words, climate change?
Oh, we can.
Well, but Carol brings up a good point, the distinction between weather and climate, but also the connection between the two, Eric. So please explain what the connection is and what the distinction is.
Technically, climate is an average of the weather over a long period of time. One of my favorite examples is related to baseball. Mm-hmm. So weather is you're an outfielder and you got to figure out where to stand after the ball has been hit, right? It's based on the initial hit of the bat, the swing of the bat. Climate change is more like trying to predict how many home runs will be hit out of a park in a certain season. You're talking about weather is the initial conditions of the atmosphere and the forces that move them forward. And climate is the sort of all-encompassing boundary of the system. It's the whole ballpark. And the concern is that obviously that long-term average is starting to contain events that we've just never, ever seen before.
Okay, so thank you. I'm freaked out. No, but I mean...
It's distressing.
It is distressing because I kind of kidded but not kidded in the newsroom. I'm like, so point of no return. We've talked about this before, and you always do give us some hope. But I do wonder, I hear this morning on surveillance, Paul Sweeney mentioning Jersey Shore, and he's seeing more marine life than he's ever seen before. We were in Connecticut and people fishing off the dock, pulling in big fish.
But is that
unusual.
anecdotal, Carol? That's the question.
I don't know. You add it all up and I wonder.
There are decades and decades of observations from all over the world, from thousands of scientists. So, the things that we see and experience every day and chat about, we do that against the backdrop of a really, really well understood phenomenon. It's hard. Nobody wants to be a downer. Mm-hmm. And there is, I enjoy coming on the show because there's always this pivot point where I'm like, wait, but we have the solutions, and it's true.
It's like Independence Day, the movie, when they're like, Will Smith's like, I can fly this.
Yeah, we'll just fly up into the belly of the ship. So there's no doubt that this is just one of our most grown-up problems, right? We've known about this for decades and have not taken it seriously. So we have a lot of catch-up to do. But the happy fact is we can do it. You know, we solar and wind and EVs are mature industries now.
We can do it. Can the elected officials who we put in office do it?
They have shown historically little interest. The Congress,
because this is not something just private industry can do itself. Fair to say?
They've been doing quite
this is
a
something
job.
That needs sort of a whole
it is a
of government
systemic
approach.
thing.
Tim,
It is,
Elon's calling. He actually would like to.
it's all hands on deck. The Inflation Reduction
Let's talk
Act.
subsidies for Elon Musk. Like, come on.
Yeah,
that's true.
Sorry, I keep like having like 3 conversations.
No.
I'm sorry.
I mean, you're absolutely right. I mean, we like if we don't elect leaders who want modernity to sort of continue, then you know how that's going to work out. But the fact is, in the U.S., in Europe, you know, in China, even there's really impressive, you know, progress in terms of funding, in terms of laws. Sometimes it's like 2 steps forward, 1 step back, 5 steps forward, 2 steps back. But the amount of people and money that are trying to solve this problem is phenomenal and growing every day.
Because I try to think about, you know, Tim, you're from California, right? And you go back to, was it the 70s, right? When the smog and so, like,
Yeah.
they obviously took steps and changed very much their trajectory.
We have a different gas, a different fuel in the country than everywhere else, in the state, rather, than everywhere else in the country, and it's more expensive as a result.
But I guess what I'm trying to, right, exactly, good, right? Changes. And what California has done has really impacted a lot of the rest of the country. But I guess I'm not trying to be Debbie Downer, but you know, when the oceans go up a certain amount of temperature, like you're really upending the ecosystem that we all rely on to eat, to food. Like, so I'm trying to understand where this goes.
I mean, it's getting increasingly confusing to know how to talk about this publicly. And like, I mean, here's how I think about it, right? Is our media, our political institutions, our businesses, whatever, and like even human beings, we're hardwired, right, to see faces in the clouds, right? There aren't any faces in the clouds. There's no bunny rabbits in the clouds, but we see them there because there's something about our cognition that that lets us see each other and little else, right? But physics doesn't work like that, right? And so we tell stories about ourselves and other people, but there's this whole world that controls the world we perceive. Cut me off any second, because it's like we're living in a physical world, and our social systems do not recognize it sufficiently, and that's how we got here.
I actually said to I was talking to somebody, and they're like, yeah, it's that climate, what is it called? And I'm like, climate change? And I was kind of amazed.
I don't know who you're hanging out with, Carol. No offense. But
I'll tell you off air.
Okay, I want to just say, I think, like, I'm wondering if we're reaching a turning point, and I wonder with the air quality that we saw earlier this year, where you can live in places that are affected by climate change. You know, if you live in low-lying areas of Florida, you know, you're going to have floods, or low-lying areas of New York, like, you know there are going to be floods. But we're now getting affected by wildfire smoke from thousands of miles away. And it's like, if there's not something that punches you in the face that says that we're all in this together, I don't know what is. Like, what's going to do it?
I'm a huge believer in turning points. I think there's turning points everywhere all the time. I think every time a suburbanite buys a heat pump, it's a turning point. Every time somebody buys an EV, it's a turning point. Every time a journalist thinks climate change, what actually is that, and starts asking questions, that's a turning point. And we're seeing a lot of them.
Can I ask you, just with like 25 seconds to go, when your space that you oversee, what do you think is the most important story that like is kind of on your radar with your team?
We can do this. You know, we can choose to do this. It just takes investment and work at this point. Like, you don't have to think about climate change if you can ignore it with climate change anymore. All we have to do is the work.
Just amazing times you're living. Thank you, thank you. We never want to stop because you're just good. You just go. That, of course, is our Eric Roston. He's Bloomberg News Sustainability Editor. Check out everything under his team, our green team. Their coverage is pretty incredible. Carol Masser, Tim Stanovic. This is Bloomberg Business Week on Bloomberg Radio.
connection lost.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story. Penn National divesting Barstool Sports to founder Dave Portnoy. That headline right now on the Bloomberg Professional Service. As we speak, worth repeating the headline there. Penn divesting Barstool Sports to founder David Portnoy. Lots of earnings after the bell. We just heard from Rivian Automotive. It is nudging up its production guidance for the year, also narrowing its loss expectation as the maker of plug-in vehicles works to reestablish itself as a rising player in the increasingly crowded EV market. After ours, we've got Rivian now at $24.35, down by just about 1.9%. Also reporting earnings after the close of trading today, Lyft, its shares up now by just about 4.3% on Lyft after ours. Turned out to be a down day on Wall Street today. Stocks, though, did close well off session lows as dip buyers swooped in following a slide driven by worries about the financial system and the economy. Dow Jones Industrial Average down 158 points today, a decline of 0.45%. S&P 500 down 19, a drop there of 0.4%. NASDAQ, the composite index, down 110, a decline there of 0.8%. 10-year yield 4.02%, with a 2-year that's yielding 4.75%. Spot gold down 11.30 to 19.25, drop there of 0.6%. And West Texas Intermediate crude higher today, finishing the session at just about 82.81. Crude today up by just about 1.1%. So again, recapping the Dow, the S&P, NASDAQ, all ending the day in the red. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Tim Stenovic live here at Bloomberg headquarters in New York City. And in our Bloomberg Plugged In segment today, we wanted to get into Tesla's new chief financial officer, who's actually kind of old when it comes to Tesla.
He's like the chief accounting officer also.
So 2 pretty big jobs now on his plate, huh?
Yeah. Well, like I said before, Elon Musk has more than one job. So it's like if he's the leader and says, okay, well, I can be CEO of all these different companies. Then
why can't you do a couple of jobs?
Why can't you do a few things, right?
All right, so let's get to it, because there was some news yesterday that Tesla was replacing its current CFO, who was in the job for 13 years. So tracking it all for us, making sense of it, is our own Bloomberg News senior technology reporter, Dana Hull. She is on the phone in San Francisco. So Dana, it does feel like, first of all, backdrop, a fair amount of movement in the executive suite at Tesla. Give us a little bit of background here.
Yeah, so when we say executive suite, there's really only 4 people. There's only 4 named executives on Tesla's website and in their regulatory filings. And of the 4, the CFO is one of them, and Zach Kirkhorn had been at Tesla for 13 years. He'd been promoted several times internally, and he became CFO 4 years ago. And Zach is really the person who kind of led Tesla to profitability. He focused a lot on costs, on expanding margins, and it was under Zach that the company kind of like steered through the pandemic, joined the S&P 500, saw its valuation soar. I mean, he is really beloved by investors. So something happened, and on Friday, he basically stepped down as CFO. His replacement is an internal candidate, Vyabhev Taneja. I'm butchering that name. Apologies.
It's okay. We're all trying to figure it out to make sure we get it right. Yeah, fair enough.
But then we didn't learn about this until Monday via regulatory filing. So, I think broad strokes, a lot of us are still trying to figure out what exactly happened with Zach and why he left. But we do have a new CFO who's, in the job now, but he's also still the chief accounting officer. So to Tim's point earlier, Musk doesn't really think much of having more than one job. He's running 6 companies himself, but it is unusual for a company of this size to have the CAO and the CFO be the same person.
Is there any concern about a conflict of interest with the person who sort of signs off on the, accounting docs versus the financial docs? I mean, there is a close relationship between accountants and, chief financial officers, but at the same time, isn't there good to have some sort of independence there too?
I would think so. I mean, I haven't heard any investors making a huge cry of this. I mean, that would certainly be a concern that I would share, but
who are we?
But I think the broader concern is that CFOs typically have pretty broad operational experience in the business. Like Zach Kirkhorn worked at McKinsey, he studied engineering at Penn, he had been always on the finance team at Tesla, but was just very much in the weeds about how the company was running, and the new guy is more of an accountant's accountant who came up through PricewaterhouseCoopers, and so it'll be interesting to me to see how long he stays in the CFO role.
Dana, we just learned about him yesterday.
I know.
This is flashbacks to 2017 Tesla. Remember that when it was every day there was an executive turning over?
Mm-hmm. Yep, I do remember.
Because you were the one breaking that news. That's how I remember.
Yeah, and this was a surprise to me. I mean, it really had seemed like Tesla's bench was pretty stable. Musk was focused on Twitter / now we call it X. The company has just had quarter after quarter profitability, so the bench at Tesla actually seems fairly stable. I was not expecting a Zach departure this summer at all.
Is there something about the new CFO and his connection to India that maybe makes it make more sense? I don't know.
I mean, Tesla obviously has a lot of markets to expand into. India has always been top of the list. All of South America, another possibility. And we've always been trying to figure out, is Tesla going to enter the India market? His name is on a filing in India around creating some kind of office there. So he probably has been involved, but I wouldn't read too much into that.
Okay, well, sorry, Carol, go ahead. No. I was going to ask about the backdrop here. If we zoom out and look at Tesla as a company and where it is right now, obviously it's come a long way, Dana, in the years that you've been covering it. But at the same time, despite all of its successes, it's still kind of clawing its way to being really sustainable. I mean, look at the way that the company has still dealt with recalls, production delays, and that old Cybertruck that still isn't on the streets.
Yeah, I mean, I think it depends on what you mean by sustainable. They have plenty of cash on their balance sheet, and they continue to be profitable. But they certainly have cut prices in order to move metal, and they don't have a truck. And I mean, Americans really like trucks, and so the longer it takes to get the Cybertruck out, the more competitors like Rivian have time to kind of really own that market. And I mean, Elon is sort of famous for introducing products that then take years to bring out. We all thought we'd see the Cybertruck this year. Now we kind of learned during the last earnings round that the only ones that they've made are release candidates. So, I mean, we're still pretty far away from anything like high volume production.
Forgive me if we already talked, I don't think we did talk about this, but I mean, Kirkhorn, I want to go back to him for a second. He walked away with about almost $600 million. Mm-hmm. And so as CFO, but
did you not get that out of your first job, Carol?
No, not even close. But that's okay. Different worlds. But I mean, could it possibly be, Dana, that he walked away from the CFO job just because, all right, I'm set, I'm good, I'm going to do something else? Or could he be ticked off that, meanwhile, what is Elon worth? Because the stock has just taken off in the last decade.
Well, there's always this sort of joke among Tesla executives and employees that working at Tesla is like dog years, right? So 1 year at Tesla is 7 years in a normal company. So Zach put in 13 years, which is this magnificently long run. And, I think he's about to turn 40. I don't know his exact birth date, but he's he's 38 or 39 on the cusp of being 40. I think that, I don't know how old you guys are, but when I turned 40, that was a big moment for me to kind of take stock of my life. And to your point, he has done a lot for Tesla. The company is in a good place financially. He's still very young, and I could see him taking on another job at some point as a CEO. I think he's got the chops to do it, and so there's a lot of theories as to why he left, but I don't have anything solid to share at the moment.
I'm sure those are things you're still chasing at this point, Dana. So
Always chasing.
Always chasing. And you know what? If you know why he left, you know how to get in touch with Dana. She's on the platform formerly known as X as well. But I don't know, not much Dana anymore. I'm not.
Well, one thing I wanted to ask you, we just got about a minute left here, Dana, is I do wonder, like you just said, you turn, as individuals, we turn a certain age and we do sometimes take stock of our lives. And is there somewhere where Tesla, which has really, had the field to itself for a long time, and now there's a lot more competition. We were talking earlier with Rivian earnings. I saw 2 Rivians this past weekend. I have not ever, I think, seen them on the road. So it's like, I feel like all of a sudden they're out there. There's more competition for Tesla. Is Tesla kind of maybe taking stock a little bit of kind of where its world is now and kind of where it needs to go in a very different environment from where it's been the last decade or so?
Yeah, probably. I mean, it's I think for so long Tesla was all about proving to the world that it could make a profitable electric car that consumers really wanted, and they have done that. They have proven that, and now they're expanding. They're building a new factory in Mexico. They're going to come out with the Cybertruck and the next generation vehicle platform, and they've kind of they're done being this kind of scrappy startup. They're part of the S&P 500 now. They need to sort of mature as an organization. And I think Zach has a lot of institutional knowledge that's kind of going out the door. But his successor also has a lot of inside knowledge. So it's not a dramatic change. But the CFO is a big deal. It's a big deal for a company like Tesla.
Yeah, and as you said, the executive suite, really only 4 people. So it's, again, some perspective. Hey, Dana, thank you as always. Bloomberg News senior technology reporter Dana Hull on the phone in San Francisco. Shares of Tesla, by the way, up 102% so far here in 2023.
Well, let's get a check on the latest world and national news. Dan Schwartzman in the Bloomberg 1130 newsroom in New York. Hey, Dan.
Thanks, Tim and Carol. Republican presidential candidate Ron DeSantis has shaken up his campaign once again, replacing his campaign manager, Janera Peck, and replacing her with his gubernatorial office chief of staff, James Ottmeyer. Just in the last month, the Florida governor has let go over 30 campaign workers in an effort to shore up a campaign that has so far faltered in trying to make up ground against frontrunner former President Trump. U.S. oil production this year is rising faster than expected and will reach a daily output of 12.8 million barrels a day. The increased output will help crude supplies that have been tightened due to Saudi Arabian production cuts. Last year, the U.S. averaged around 11.9 million barrels a day. Globally, production is expected to increase to 103 million barrels a day in 2024. That's up 1.7 million barrels a day from this year. Ferocious storms in the eastern part of the country have left a wake of destruction. Bloomberg's Steve Rappaport with more.
Thousands of flights were canceled or delayed yesterday, and more than 1 million customers lost power as storms moved through the region. The wild weather prompted tornado watches and warnings in 10 states from New York to Tennessee. The Knoxville Utilities Board described damage across its service area as widespread and extensive. News outlets reported the storms toppled trees and power lines in multiple states. The National Weather Service also issued a flash flood warning in Maryland after 4 inches of rain fell in a short time. Steve Rappaport, Bloomberg Radio.
Thanks, Steve. The Mega Millions jackpot for tonight's drawing is estimated to be a record $1.55 billion, beating the previous high by almost $20 million. The jackpot is the 3rd largest in U.S. lottery history, topped only by 2 Powerball drawings, one of $1.6 billion and just over $2 billion on the other. The cash payout option will be around $757 million before tax. It all sounds great, but the odds of winning are 1 in 302.5 million. Good luck. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. After an initial move higher for Rivian Automotive, the stock is now lower by 1.6%. Rivian, after the close of trading, pushed higher its production guidance for the year and also narrowed its loss expectation. Lyft is out with earnings that far exceeded Wall Street's expectations. It raised its outlook for the quarter in a sign that its strategy of slashing fares and trimming costs may be working. But after ours, we got Lyft down now by about 6.5%. Take-Two Interactive Software, the company behind video games like Grand Theft Auto, higher in extended trading after management predicted a big 2024, overshadowing lower than expected results for the latest quarter. A down day for the Dow, the S&P, and NASDAQ. S&P fell 19 points today. Lots of concerns for investors. The S&P down 0.4%. The Dow down 158, also down by 0.4%. NASDAQ, the composite index, down 110 points, down 0.8%. 10-year yield 4.02% with a 2-year yielding 4.75%. Again, a down day for the U.S. equity market. And Sam Stovall, chief investment strategist at CFRA, was a guest right here on Bloomberg Business Week, and he pointed out we are in a seasonally tough time.
Being a reader of the Stock Traders Almanac and doing my own research, realizing that August is the third worst month of the year, second worst for the NASDAQ, but then we have September, which is the worst of the year for both indices. Just from a seasonal perspective, maybe we are entering into a digestion phase because, let's face it, the NASDAQ was trading at 26% above its 200-day moving average, which is a statistical extreme.
And you can hear more of that conversation on the Bloomberg Business Week Surveillance podcast. You can download it wherever you get your podcasts. Again, recapping stocks lower, S&P down 19 to 44.99, a drop there of 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stanovic live here on Bloomberg Business Week. And you guys talked about Zoom yesterday, right?
Yeah, I mean, if you think about perhaps the company that most epitomizes working from home,
yeah,
it's Zoom. I mean, it was not just a COVID stock, but it was also what we were all learning how to use in the early days of the pandemic, right? We talked about it yesterday because even they're telling employees to get back to the office,
Wait,
Carol. Yeah, I know. Zoom. If you live near a Zoom office, you got to come in a couple days a week. So we've seen Amazon, Chipotle, BlackRock, companies as varied as those telling, hey, workers, hey, you got to come back to the office.
Yeah, it's interesting, right? We're seeing that post-COVID several years out and how that is kind of, yep, they're coming back to the office. The other thing at play, right, we see when it comes to how we are working going forward is just the explosion of what the think about AI, around artificial intelligence, generative AI, and what does it mean eventually for work?
Well, fortunately, McKinsey is out with a new report that says 12 million workers are going to move into new lines of work by 2030. I guess I'm not saying fortunately. Fortunately, there's a report.
Yeah.
We'll see if it's fortunately or unfortunately that AI is forcing people to move to new lines of work. Very pleased to have with us this afternoon Quaylin Ellengrood, partner at McKinsey Global Institute, joins us via Zoom from Minneapolis, a director and senior partner at the McKinsey Global Institute. Quaylin, how are you?
Great to be with you today.
Well, it's great to have you join us on this. So, when did you guys start thinking about the impact of AI on workers? Because I think for a lot of people, this is a relatively new phenomenon with the explosion of ChatGPT last fall.
Absolutely. We've been thinking about the future of work now for about a decade and modeling what does automation do to jobs, which are biggest gaining jobs, losing occupational categories. And then to your point, just about 6 months ago, started to layer on to automation and COVID-19 impact, the impact of Gen AI. So now we've put all of those three things together to say, what do the future of jobs look like in the United States?
All right, so play it out for us. What do they look like?
I am a robot.
Absolutely.
Yeah, I'm a robot.
Indeed. I think the bottom line is about 30% of the activities that U.S. workers do today could be automated away by the end of 2030, so over the next 7 years. And that, again, is through automation, COVID-19 impact, mostly affecting interpersonal interactions, and then Gen AI. Gen AI alone, if you just isolate that piece, increase that percentage by about 8 or 9%. So up until about 30% of overall activities. There are a lot of jobs that will be fewer in the future, and there will be quite a few more. Overall, I think it's good news. To your point earlier, we will have more jobs in the future, I think is the great news. And those jobs will be higher paying jobs. They will be also higher skilled jobs that on average require higher average education. The tough news or the tough transition to get there is we don't necessarily have the workforce today that is best suited for those jobs of the future. So first, where are we gaining? Where are we losing? We are gaining jobs in healthcare, in STEM categories, and in transportation, delivery, all of those other areas. We are losing jobs in primarily 4 big occupations, and those 4 occupations make up about 80% of the job losses between now and 2030. That is customer service, food service and sales, production or manufacturing, and office services or assistance. And you've all seen kind of food kiosks at fast food restaurants, right? We've seen all of these different elements, but when you add them together, those 4 occupations make up 80% of the occupational switches, which is about 12 million of them between now and 2030.
So before we get into that, that's a lot. But I've also seen it. I've done it, right? I'm at a airport. I order on an iPad, and then stuff just gets delivered. I've gone to a retailer here.
I'm sorry, but
What?
You and I have done this before.
And sometimes it works.
It's also just terrible.
It's not all the time.
Maybe I'm just thinking of Newark Airport. I don't know. No offense.
Oh, come on.
I know.
Pick
but
on the New Jersey.
We've had some fun times there.
We have.
But
it kind of works.
I don't know.
It doesn't always work. It's like not perfect.
It doesn't always work.
But I'm amazed at that. I think how many times I check out at a supermarket, I go there, a Target, a retailer, Zara. You go to Zara, you drop it in a bin.
That's amazing.
It shows up. That blows my mind. It shows up on
I think H&M or Uniqlo does that too. It's amazing.
Do they?
Yeah.
And you check out and you take off the safety. Whatever what do they call them? You know what I mean?
The anti-theft things.
The anti-theft things. Like, I do it all. And, like, somebody's watching you, but it's like, whoa. So, I don't know.
Is the experience better, though? That's the thing. Like, speaking of airports, we've done this, we've gone to airports together where there's nobody to actually check us in, right? And we're like, we know it's because of cost cuts.
And we're flying business. Thank you, Bloomberg.
We
do everything.
But what's the balance here, Quaylen, of actually having like an experience that's better? Because who cares not who cares, but it's like, it's one thing to replace people. It's another thing to replace them with, an inferior product.
And I thought all the companies were about customer service, customers first. Not apparently.
And there is absolutely a balance, and there's also a bit of a transition pain point to get there. But I think the alternative is not always great customer service in person. It could be they're understaffed, they don't actually have the people. And so the alternative is, do you want to wait for 10, 15 minutes to flag somebody down to get your order, or do you want to enter it into the iPad? Or do you want to pay $2 more for that sandwich? Or not. And so I think those are the trade-offs that we're really wrestling with.
Well, when does the cost come to us? Because I go to the supermarket and, man, I'm doing all the work, or I go to the airport and they're like, you want an extra bag? So when does that cost come back to the customer?
I think we've already started to see it, right, on so many different products. Some of that has been passed along. Some of the costs have been kind of captured and improved, better efficiency and effectiveness, part which has not then been passed on in higher prices, even though supply chains have been challenged and prices across many categories have gone up, most notably in service and gas areas. I think some of that will flow through over the next few years. We'll see where it all settles out. Yeah. But I do think there are automation improvements that are being made, and then, consumers do stand to benefit from some of that.
Hey, really quickly, 30 seconds, because we've got a story coming up about the lack of workers in the healthcare area. You said we are seeing gains in healthcare. 30 seconds, what specifically?
Yeah, frankly, across the board, given consumer spending, aging in the United States, and frankly, in many developed countries around the world. So nursing, tech in healthcare as well. overall, I think we'll need quite a few more jobs in those areas.
Well, that certainly fits into the story that we're going to talk about. Quaylin, thank you so much. Quaylin Ellengrud, she is Director and Senior Partner at McKinsey Global Institute, on Zoom from Minneapolis. Their latest report, Generative AI and the Future of Work in America. It wasn't so bad in Newark.
Please enter your symptoms on this iPad.
Exactly. Who do I complain to? That's the thing that bothers me. There's no one ever to complain to.
Complain to me, Carol.
All right, I will. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Shares of Novo Nordisk soared to a record today, boosted by the results of a new study regarding its obesity drug Wegovy. The Danish drug maker said the medicine cut the risks of heart attacks and strokes by 20%. Bloomberg intelligence analyst Michael Shaw in London says the results could broaden access to the drug.
Typically, or historically, obesity has been an out-of-pocket market. So this trial really formalizes a link between, reducing body weight and improving cardiovascular outcomes, and that should hopefully provide, Novo with the necessary ammunition to go to payers and really drive broader reimbursement.
And Shaw says the next step for Novo Nordisk is to present detailed data to regulators. Shares up today by 17.2%. Eli Lilly shares shot up as sales of its promising weight loss treatment blew past expectations. That stock, Eli Lilly, up today by 14.9%. AMC Entertainment Holdings reported a modest second quarter profit, beating analyst projections for a loss thanks to the strong theatrical performance of the Super Mario Brothers movie. After the close of trading, we heard from Rivian Automotive. It nudged up its production guidance for the year and narrowed its loss expectation. And also reporting after the close of trading, Lyft, it's out with earnings that far exceeded Wall Street's expectations, and it raised its outlook for the quarter. And those are the top company stories we're following for you at this hour, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
Well, it is Bloomberg Business Week. Carol, it's great to have you back.
Thank you. It feels good to be back.
Carol Masser is the voice you heard. I'm Tim Stenivek. And let's get a check-in on the latest world and national news. We've got Dan Schwartzman in the Bloomberg 1130 newsroom here in New York. Hey, Dan.
Hey, Tim and Carol. China has been surpassed by Mexico and Canada as a top goods provider to the U.S. in the first 6 months of this year. The U.S. imported around $203 billion in goods from China. That's about 25% less than the same period last year. Goods from Mexico, though, up close to 5.5%. China had been the number one supplier of goods to the U.S. for over a decade, with trade ties reaching a peak last year. Voters in Ohio are casting their ballots today on whether to increase the threshold for amending the state's constitution, with the future of abortion rights in Ohio potentially at stake. Bloomberg's Amy Morris reporting from Washington.
The GOP-backed referendum, if approved, would require a 60% supermajority to amend the state constitution. Currently, all that's needed is a simple majority. This special election is being held before November's likely vote on an amendment that would protect abortion rights in the Ohio Constitution. Supporters of the amendment say they're trying to stop special interests from embedding their agenda into the Constitution. Opponents say today's election is designed only to stop the abortion rights amendment. In Washington, I'm Amy Morris, Bloomberg Radio.
Thanks, Amy. Los Angeles city employees have walked off the job for a 24-hour strike alleging unfair labor practices. Those walking off include sanitation workers, lifeguards, as well as traffic officers. In total, over 11,000 workers are striking as their union, SEIU Local 721, says the city has not bargained in good faith while also engaging in labor practices that restrict their employees and their union rights. This strike is just the latest to roil the city, as currently both Hollywood and television screenwriters as well as actors are on strike right now. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Carol and Tim, back to both of you.
All right, Dan, thank you so much. So can we talk about one of the stories that is among the most read on the Bloomberg?
Yeah.
It has to be with UPS driver jobs.
I love this story.
Me too.
$170,000 to be a driver at UPS. That salary is spurring interest after the Teamsters deal. UPS, Carol, has become a hot employer since the union last month secured a $30 billion in new money over a 5-year contract. Excuse me.
You okay?
I'm okay, yeah.
You eating a banana?
You got to read the fine print of what it takes to become a driver. You can't just sign up to be a UPS driver.
No, I mean, it's a lot of training, right? And we're talking about, I think, 170,000. Isn't that for kind of the top end of people, or is that starting?
That's a good question.
UPS, okay,
Full-time drivers will make around $170,000.
Annual pay and benefits by the end of the 5-year contract. Part-time employees will earn at least $25.75 per hour and receive full health care and pension benefits. This all stands far above industry standards. Enthusiastic UPS wannabes should know that the path, though, to that coveted driving position, as Tim mentioned, far from a smooth ride.
Okay, here's how you do it if you're interested. So to become a driver, an employee first has to work, quote, inside the building as a package loader.
Check.
So these jobs pay less, and they're mostly part-time since UPS has 2 package sorting rotations a day, and the hub is mostly shut down in between of those. They do, however, get the same benefits as other UPS workers, and in a way, workers still have to prove themselves before they can slip into the driver's seat, which often takes several years.
Once you become a driver, the company starts workers at the lowest level. The job won't be a nice Monday through Friday, 8 a.m. to 5 p.m. shift. The route will most likely involve toting heavier packages and making many stops. It will, however, pay significantly better than its contractor counterparts at FedEx, Ground, or Amazon, neither of which are unionized.
Yeah, we have to note it's FedEx Ground. those trucks that you see around the FedEx ground, the UPS
Correct.
competitor, those are contractors, and you can see on the trucks who actually owns the trucks and who's providing that route. The pay is very different than UPS.
I mean, listen.